There's a lot of nuances and there's a lot of things that go on in our industry that we see that other people don't necessarily see or understand.
DeFi is, in its simplest terms, it is basically what that is basically financial services built on blockchain technology.
Part of the digital revolution comes a lot of new innovations, a lot of new movements, and you really do need to be aware of them so that you can understand opportunities when they come your way.
DeFi is in its infancy. What that means is there's still a lot of risk.
So we've covered a couple of major risks when dealing with decentralized finance so far. So what else is there?
One of the biggest risks outside of both of the personal and the smart contract risk is,
why would someone do this to begin with? Why would someone even bother to use their crypto to take money? What's the whole point?
I think the main point of this is...
Okay, welcome everyone to another episode of Proof of Success. Kane and I were actually talking just recently. We realized that we never actually did a proper introduction as to what proof of success is and what it actually means.
Yeah.
So I'll make an attempt to cover that all for you now. So yeah, Kane and I, on our journey of working together, we sort of realized that, there's a lot of nuances and there's a lot of things that go on in our industry that we see that other people don't necessarily see or understand. But also, that a lot of people who support us, they're actually pretty interested in our journey and any teachings and that we can provide through our wins, our successes, or even potentially mistakes. And, just so people can get a real temperature for what's in the room when it comes to our industry, because, what naturally occurs to us doesn't actually naturally sort of occur to a lot of other people. So, it's not just talking about crypto. While proof of success is essentially a play on words on proof of work, like the algorithmic model in which cryptocurrencies are born, so to speak, or minted. We won't go into the technicals of that, of course, but we thought it was a nice sort of play on words because we do want to sort of, go into like things like business strategy, crypto, like the general economic climate, but also the macro and micro in crypto. But even cover like general business topics, bring in other founders and other people either working in the industry or potentially have a loop in, or even if we just feel that person has some value to provide to viewers and some really interesting point of view or takeaway. But the idea is the Proof of Success podcast really is only just to provide value to viewers. And yeah, we would love to hear some feedback if anyone has any topics or anything that you'd like to cover. I know that recently we had some really great feedback on our podcast about scams. So that was amazing, to see people engaged and wanting to know more about that. We could possibly do a part 2 if people are interested. But yeah, so essentially to sum it up, what listeners can sort of expect is, I guess stories and, things that are going on with ways that they could possibly apply them to their day-to-day life or even, apply it to some of their personal investment or personal strategies.
Yeah, and to be honest, I love the one that obviously you and Cal recently did. Also highlighting the challenges of high, performance leaders like yourself is really interesting to a lot of people. So yeah, being able to break that down and, discuss the lives of different founders is something that I find will be very valuable for a lot of viewers. Yeah.
Thank you, Ken. And Cal he's obviously someone I've worked with before. He works with us as well. So we've got a pretty good, business relationship going on there. But at the end of the day, we are great friends. And I do really respect him as a human, but also respect, what he's been able to achieve in such a short time. Our listeners probably look at that video and they're like, who is this guy? He's really young and, he's speaking really raw. But that's what you get. You get a young, successful entrepreneur who essentially doesn't have time for shit, and, we want to be able to bring interesting people on board and how can I put it? We want to bring a wide array of people with different opinions and different perspectives because, how much can we talk about general crypto news this week? We can talk it to death, but let's be honest, like you can get that from any news outlet.
Yeah.
So our job, what we're trying to achieve is trying to bring new, fresh perspectives and opinions to the table. And look, not everyone's going to agree with some of the stuff we say. But at the end of the day, it's an opportunity to open up a wider discussion about it, right?
Yeah, 100%. And you get to kind of look outside of the box a bit as well when you get to bring these different, characters into the picture, because obviously Cal doesn't have the most crypto knowledge in the world, but the fact that, he's been able to establish some sort of crypto model within his business, gives a bit of an outside perspective on how that can actually influence different businesses as well.
Yeah, exactly. No, I think it's really valuable, and look, we love it. We're all kind of new to this, and we're doing our best. So any feedback is absolutely welcomed from our clients and viewers and things like that. Anyway, we'll move forward. We're going to make it a bit more about you today, Kane, because you are one of the big brains in our business. While you do look young and handsome, you are quite dangerous on the research and analytics front. Very sharp-minded guy. So for those who don't know or can't remember from previous episodes, Kane is our head of research and analytics. He did work at a few big name hedge funds in the crypto industry. So we were lucky to be able to get him on board at Uptrade at a very early stage, and he's been with us ever since. So we realized that we are talking about in crypto a lot of very complicated, nuanced concepts which not everybody can fully grasp. And we sort of figure that it would be good for us to, this episode, essentially take a step back and go through a few of those topics to really drive home what they mean, but to give the viewer, you guys, a greater understanding of, our industry and what the implications of these different narratives or products are. So we're going to do a topic, introduction to DeFi. So Kane, would you like to explain what DeFi is?
Yeah, definitely. Well, thank you for the intro. It was a very kind way to intro me. But yeah, obviously I've been in the market for 7 years. And as you said, the jargon of the crypto world is very hard to understand. To be honest, I reckon it took me a few years just to understand the different, jargon and terminology that they use. So yeah, really good opportunity for us to break that down to its most basic level, and DeFi is a great one to start with. So if we are to explain what DeFi is in its simplest terms, it is basically, it's an acronym is for Decentralized Finance. And what that is basically financial services built on blockchain technology. So for example, you could have a lend and borrowing service that's built on Ethereum, which is a blockchain. And basically what these allow us to do, because they're decentralized, is remove the middleman. And if you want to compare it to our current financial system, which is probably the best thing to compare it to, we heavily rely on an intermediate third party like a bank, or basically someone who will allow us to have a buyer and a seller, or who can connect the two parties of a contract or a deal. But this way, they use something called a smart contract. And I'll try to break this down very simply to you guys, because what it is just a bit of technology where it's got a few coding algorithms in it, and it basically acts as the middleman for a transaction to occur. So they don't have to have a bank or so to, connect two people to a deal or a trade. So I hopefully that is of somewhat simple terms. Do you think we could go a bit further down, Jeff?
So let me sort of reiterate. So yeah. Decentralized finance is essentially a way that you don't need to use a centralized party like your local bank, like Bank of America, to be able to interact with the financial system or the decentralized financial system. Yeah. So it's kind of like why Bitcoin was invented. It's peer-to-peer money, but DeFi is like peer-to-peer financial products. So we mentioned lending and borrowing. So it would mean that I could borrow money directly from you, my friend, without the need of a bank, and I could borrow money from you, or we could do some sort of financial transactions there. And what essentially dictates the terms of our agreement is a contract, but it's a smart digital contract. Is that what you're sort of saying?
Exactly, and you broke it down probably to the most basic level. And, this technology is something that's, evolving every day. And we're seeing more innovative things come from it, new ideas, new applications or services that are being built using blockchain technology and, into the DeFi space. And I think, we'll quickly cover a few key benefits as well. Obviously, being decentralized, being peer-to-peer means we have full control. It means that when we have our assets, we don't have to rely on a bank or a third party to make a transaction happen. And everyone knows that they can be somewhat non-reliable at times, especially if you're trying to transfer large amounts of money from one place to another. I mean, this way you can just send it straight to your mate, say $250,000, and it's done in 5 minutes. It's a really strong way to remove that reliance on an intermediate party. Also encourages transparency because it's all built on blockchain. It means you can't hide transactions. Everyone can see transactions occurring. And then the other thing is that it's open and accessible to everyone. So you don't have to, worry about not being able to open an account or, if you can't borrow against some of your collateral, which is such a big thing in the modern world. Like you could have so much money or you could have a certain amount of money. And there's so many families and different people who just cannot take loans. So this way, you can actually take a loan on the collateral that you have based on what you hold in your wallet.
Okay, so let's say that you wanted to go onto one of these decentralized markets. Let's say you've got one Bitcoin, right? One Bitcoin's what, like 87, 88,000 at the time of recording, something like that?
Yeah, exactly.
Okay, so you got one Bitcoin collateral, and let's say that you can take out a loan in stable coins, like 50% of that value. Let's just round it off and just say like, $45,000 or something like that, right? So you get the loan. You've signed for the loan's terms. The loan's terms might be a 90-day loan or a year loan, and it gives you an X percentage interest rate on top of that, right?
Yep.
That's typically how they're sort of structured, yeah?
Yeah, so sometimes they can be time variant and sometimes they're not. It just depends on how much collateral you put down and how much you're borrowing because, if your account becomes negative, then it will start to liquidate some of your collateral, which you don't really want.
So let's say the price of Bitcoin drops to $50,000. Will the smart contract then seek to sell some of that Bitcoin to pay off some of the loan to reduce the risk of the liquidation? Is that what sort of happens? Or?
Yeah, exactly. So if you have yet to pay back your loan, then it will start to liquidate a certain amount of your Bitcoin. There's called a liquidation price when you're borrowing against collateral. Okay. So yeah, that does happen. The only thing is if you do lend stable coins, obviously you don't have that liquidation risk that can occur.
Okay, so if I was to borrow against a really volatile asset, that could potentially be just a really bad idea, right?
Yeah, 100%. Especially if you're trying to use what you're borrowing. Say you're going to borrow USD using a very volatile asset. If you don't pay that back in time, you can expect that, that could be fully liquidated. And then maybe the next day that goes back up in value, but it's too late. They've had to liquidate that position for you to pay back the loan.
So why would someone do this to begin with? Why would someone even bother to use their crypto to take a loan? What's the whole point of it?
I think the main point of this is the attractive interest rates. Usually a lot of people are looking for passive income or opportunities when they've got, assets they're already holding. For example, if you've got a Bitcoin and you don't want to sell that Bitcoin, but you want to maybe buy something else, then a lot of people might use that as collateral and borrow against it. Or some people might just lend it and take the 5% APY that they might get. It's more or less because a lot of people still have that mindset of how can I get the most value out of my collateral or assets that I'm currently holding.
So it's kind of like, in a way, you're kind of mortgaging your Bitcoin, right? In a way.
Yeah.
Just to like put it into terms that I'm sure most people watching this would have had a mortgage in their time and they can understand how to borrow against an asset, right?
Yeah.
So it's kind of similar with Bitcoin, with DeFi. There's just no bank involved. And so who kind of dictates this yield that you're talking about? Like obviously the bank, they have an interest rate that they give, and banks have different interest rates. But what dictates the market for, yields? If I lend some Bitcoin to you, like what dictates that? Is it a competitive market thing against other people, or is it you, or is it me? Like how does that work?
Yeah, so it is more or less a competitive market where demand will drive rates. So if there's more people borrowing and there's not enough liquidity, you would expect that the borrowing APY is going to be higher. And the same thing goes when there's a lot of people trying to lend their money and not so many people trying to borrow, then you would expect that the lending APY is going to be lower. And that's more simply how it works.
So it's like you said, it's essentially like a supply and demand. If more people need to borrow than there is assets to borrow, then those people can dictate really high interest rates.
Yeah,
but
exactly.
If money's cheap, everyone's lending, but no one's wanting to borrow, then obviously the rates are really low.
Yeah,
and we do see these fluctuations like in bear markets and bull markets. In bear markets, the yields are really low because no one wants to take risk. But in bull markets, the rates are crazy because everyone wants to take advantage, to continue to leverage and try to make more money, right?
Yeah, exactly. You see it so many times in a bull market. There will be so many different applications that have, yields upwards of 20, 30% just because of how much demand there is in the market. But that is honestly where the most risk comes, because that's where people become a bit complacent around where they're, borrowing or lending their money, or what applications they're interacting with, because DeFi is in its infancy. And what that means is there's still a lot of risk. And that's a lot of probably the biggest reason we haven't seen a lot of global adoption when it comes to DeFi and that service, because I think a lot of people do think it could be the future of finance, and that's what it's really shaping up to be. But there is a lot of risk involved when interacting with these, and it's important to know what risk there is.
Great that we've sort of rolled onto this topic naturally, because with a bank, if you default on a loan, they can come and take your house or your car or something from your business, or who knows, maybe someone can send loan sharks around your house and hit you with bats or something. There's a million ways to recover funds, right?
Yeah.
But what happens in DeFi, because there's the third party is a smart contract. It's a piece of code that has a written agreement based on certain terms that we've both agreed to. So what happens if, what can go wrong here?
So I think the biggest risk involved is your liquidation risk, which is obviously when you're lending your assets, that if the price of your assets goes below how much you've borrowed, then that will fully be liquidated, and then you'll only have left what you borrowed.
So let's just say you borrowed 1 Bitcoin and the price is 87,000, and I borrowed from you, and we agreed that you'd give me $30,000 in USDC.
Yeah.
Right. So if we went down further, and let's say we really took a dive from here, it'd be catastrophic, by the way, but let's just pretend we did. Let's just go there. We hit the 30K. So 30K would be the amount that I took out as a loan, but that would also be my price that the smart contract would automatically sell the Bitcoin just to recover the lender's funds.
Yeah, exactly. So it means that you're never negative to what someone owes. So you always have to pay back the lender, which is a really strong and important part about the whole smart contract. It means that you can't go, as a lender, you don't have to worry about that. You don't have to worry about being paid back, because it will automatically do it if someone does get liquidated. Okay,
so it sounds like the risk is actually more on the borrower's side here, because if I decide to take that $30,000 and I go, look, Bitcoin's doing well, but I'm going to get really greedy here, and I think that meme coin A is going to do 100x, and let's say it doesn't, and I don't have the ability to pay the loan back. Let's say I just invest it at the worst possible time and it just draws down 99%. I don't have the money now. So essentially I would need to find a means to pay back that loan in crypto, or I would lose my whole Bitcoin.
Yeah, exactly. That's exactly how it happens. And I think that's a lot. It is a very big way that a lot of people lose their money in a bull market, because when everyone's borrowing and trying to make more and more money because there's so much greed in the market, this is what happens, and they lose their initial positions, which should be, their core portfolio.
It sounds too risky. It doesn't really, like, I've never done this myself. I know of people that have done this, but I've seen people do it really smart and use it to like actually do stuff that they need to do with the money, knowing that they have some sort of backup to pay the money back in the future. Or, perhaps, I've seen people do like really dumb things with this. Like I just mentioned that example. So I know that there could potentially, depending on where you are in the world, I'm not a tax expert, but there are sort of, if you were to sell the Bitcoin for $87,000 or sell a fraction of a Bitcoin to get the $30,000 loan and put it in your account, is the reason that people are avoiding this to not pay tax on realize a gain on the Bitcoin itself? Is that what you think the reasoning is behind using something like this, like keeping it within the ecosystem? Because I know some places perhaps their laws will say if you sell the asset, you've got to pay tax on it. But if you were to lend against it, you don't necessarily have to. And this obviously depends on your jurisdiction and what advice you're getting and how you're structured and everything like that. But, do you think that's the reason?
As you said, a lot of different jurisdictions have their own tax rules. So it's hard to tell whether, you can or can't be subject to capital gains tax if that does occur. I know that there are some and there aren't some. So yeah, it is more or less another big thing to look at if that's obviously subject to your country.
Okay, so in summary, it just makes sense to speak to a licensed professional before you decide to go lending or borrowing your crypto.
Yeah, 100%.
Right? Tell me a little bit about what the risks are with smart contracts, right?
Yeah, awesome. So what we currently just talked about was the risks if everything about the protocol or service was fine. That's only your risk. But in decentralized finance, we have smart contracts and there is smart contract risk. What this basically means is that sometimes what occurs is there might be a little bug or might be a little error in a smart contract that allows someone else to exploit it. So hackers, there's so many really smart people who are looking for any way to exploit smart contracts for their benefit. And what that might mean is they can get into a smart contract, change a few bits of the code, and basically hack the whole protocol.
So you're telling me, because this thing's fully transparent, it's on the blockchain, I can see the smart contract, and if I'm smart enough, or I've got a company of 10,000 people who are smart enough to figure out where the vulnerability is, I could potentially steal all the money, the tens of millions or potentially hundreds of millions of dollars locked up in a smart contract. Is that true?
Yeah, 100%, exactly. And we saw this literally a few years ago with Euler Finance. Around $200 million was stolen from this lend and borrowing project. And
oh my God,
these funds weren't even recovered.
I couldn't imagine of something more like horrifying to hear.
Yeah, exactly. Especially if you had, were lending your money in there, not even borrowing against it. You could be lending, your Bitcoin just for like 5%. You wake up on the phone, Euler Finance has been hacked for $200 million. Goodbye to your Bitcoin, or goodbye to your wrapped Bitcoin, Ethereum. It's all gone.
So we sort of touched on before, the recourse if you were to take a loan through a bank or, even a peer-to-peer, like you and I would have lent to each other or something like that. But what is the real recourse here if, a smart contract platform such as Euler Finance they get exploited? What can I do as a user that's lost $10 million?
Yeah.
What do I do there,
Unfortunately, there really isn't too much you can do. A lot of the time, these people can get away. And one of the biggest hopes you would have is that they're a white hat hacker. And what that means is that they might be exploiting a project, but they're going to return the funds for a bounty. And they're not actually their interest isn't to steal everyone's money. They're more or less trying to better the protocol and find exploits and bugs before black hat hackers do, which are the ones who will just take the money and run. So honestly, there's not much you can do. There's situations where these funds are never returned, and these people might lose millions of dollars, especially if you've got a large amount of your money in it. So, unfortunately, there's sometimes nothing you can do.
Yeah, I don't know how easy I feel about rolling the dice of probability that a hacker who's successfully stolen $200 million is actually the good guy, and they're going to hand the money back. It has happened. It has happened a few times in history so far. It has happened internally, or it could just be someone who's, like you said, just trying to do it for the greater good. But as we know about life and the way people are, there's very few people like that in the world. And like you mentioned, a lot of the times, a lot of these hacks and exploits, the money never comes back. I think some of the biggest hacks in history have been something like North Korea, the Bybit.
Yeah.
Even like the Axie smart contract or their cold wallets, Axie Infinity.
Yeah.
They got exploited for like $1 billion or something. So I think what we're trying to sort of reiterate is, there are people out there, organizations, organized crime, even countries, their sole purpose is to breach these contracts, right? And they know that they can hide the funds well enough, and they're smart enough to get in to begin with, that there's probably not going to be any recourse for the end user. So you've pretty much lost 100% of your investment for a 5 or 10% per annum yield. Is that correct?
Yeah, exactly. I mean,
does it make sense?
To be honest, no, unless, you're only playing with a small amount of money, but at the same time, you would never put all your money into something like this. There's too much risk, in my opinion.
But some people do, though. That's the problem. This is why people lose out, because they go, all right, if I put in 5% of my crypto, which might be 50 grand, let's just pretend it's $50,000, and I'm earning 10% on $50,000 per annum. That's not really enough. But if I put $1 million in, I might be able to earn some pretty good passive income, right? So it kind of like plays into people's greed a little bit, yes?
Yeah, 100%.
So this is where it comes down to like that too good to be true. Maybe it is.
Yeah, and thankfully we've, learned quite a lot from the past, and there are a lot of reputable services and different DeFi applications that you can trust. They obviously have their smart contract risk still, but they do get audited by some of the top hacking and different smart contract backed engineers in the world, where they're looking for the bugs and stuff every month. So being able to know that they're getting theirs audited by the best of the best is a really strong way to know that you're having a more limited risk. Obviously not zero, but it's definitely a lot less.
Okay, so we've sort of covered a lot of the bad stuff and the bad guys that can sort of get involved in this, but it's good to know that there are a lot of good guys as well out there sort of upholding this. And there are still, by the way, billions and billions and billions of dollars that are being used in DeFi every single day.
Yeah, 100
if
billion.
Nobody, sorry?
100 billion.
$100 billion a day.
Yeah.
So if there's, there's obviously a lot of people that have a lot of confidence in these smart contracts and their ability to deliver on their promises.
Yeah.
So we've covered a couple of the major risks when dealing with decentralized finance so far. So what else is there?
So one of the biggest risks that outside of both of the personal and the smart contract risk is in bull markets especially, we see so many different projects launch, and they're literally launching every day. You'll see a new one pop up, and they're offering like 100, 1,000% APY on their projects, and like where you can actually earn a lot of money. But a lot of these are, and I promise you, around 99.9% of these are Ponzi scams, where you put your money in, they're offering amazing yields, and you just lose it all. You wake up the next day and it's just gone. This is the wild, wild west in the crypto land, especially DeFi. And if you're not doing your due diligence on projects, and especially when you've got such high rewards, this is where a lot of people become so complacent around what they're actually interacting with. And that's a massive risk.
Okay, so let's just say I'm using Aave as a pretty popular DeFi protocol. They offer pretty low yields, but they're like heralded as probably like the longest running and one of the safest DeFi platforms out there. Nothing's completely safe, guys. Just want to let you know.
Yeah.
All right. And then let's say they're offering like a few percent APY as well. So APY stands for annual percentage yield. It's pretty much just what you're going to earn on average, and that can fluctuate per annum, right? So if I've borrowed from Aave and I'm earning 2 to 3% per annum, right, on $100,000, I'm like, all right, I'm earning $2,000 to $3,000. It's okay. My money's working for me, but it's not the greatest, right?
Yeah.
And then I look over at, we'll just call it scam finance, right?
Yeah.
There's a new protocol. It's just a new kid on the block, and they're offering something like, 2,400% per annum, right? And I go, well, what you mean by complacent is I look at what I'm getting and I start to feel a bit of FOMO, a little bit of, I should put some money over there, right? And it doesn't happen all at once. You put a little bit over there and you're like, oh yeah, this looks okay. And then you do a little bit more, and then you just go full risk on, right?
Yeah.
And then all of a sudden, you possibly find out that those yields weren't real.
Yeah.
So how would the mechanics of that work,
So how this would work is usually either someone in the back end actually hacks the protocol and everyone's money's lost magically from a different hacker, whereas a lot of the time it might be actually someone running the operation itself. And the other way is that they're offering their own token as yield, where basically you're having to provide liquidity on both sides. So maybe you have both tokens, like a US dollar and their token, and they will just dump their token to zero and your USD becomes zero. You're just left holding all their token that's worth nothing. And that's such a big way that a lot of people do it.
Okay, so if this were to happen to me, for example, I would go to Scam DeFi or Scam Finance.
Yeah, Scam Finance.
I would deposit my $100,000, but it would incentivize me to buy Scam Finance's coin.
Yeah.
So I'd buy the coin, I'd lend out my money, or just do a swap on their website.
Yeah.
And then I would get, say, 1 billion Scam Finance coins.
Yeah.
Right? And then from there, they'd offer me really attractive rates to stake it on their platform. So it's kind of like earning interest. I'd need to lock it up for a period of time.
Yeah, exactly.
And then when the Ponzi sort of collapses and they've stolen everyone's money, that's when you're left holding this useless coin and they've got your stable coins. Is that kind of how it would work?
Yeah, 100%. And I see it happen so many times, and especially in the bull markets because everyone's just playing around with everything.
Okay, wow. All right, well, that's kind of in a nutshell how it works. And look, we've probably seen about 100 or maybe 200 different variations of this same type of model, but it mostly plays on people's greed. Would you agree with that?
Yeah. Well, I think a lot of mistakes that are made in crypto is honestly through greed, because a lot of people just don't understand, or they just don't do due diligence on things. And like, I feel like in most other markets, people are doing due diligence on, where their money's going and what's to be trusted and things like that. But for some reason in crypto, a lot of people just set that aside and will put money in anywhere. And I think that's where a lot of people just, get stuck.
Yeah, because we live in a world that's mostly bound by rules and regulations and punishments, right? There's something that kind of guides the hand of justice and the law and things like that, right? To a degree. And then you've got the Wild West in DeFi, where people can kind of, free to run rampant scams and get away with it. Yeah. And then do you think it's like the natural sort of trusting nature of people just to believe that, what they hear? And, it's like, if you don't know there's risks, how are you going to know there's risk? It's kind of like until it's too late. So if you don't know there are risks, how are you supposed to know until it's too late?
Yeah, I think you're 100% spot on. People just don't realize that, when these things happen, you lose your money. Honestly, you're not going to get it back. And that's the tough thing that a lot of people just don't realize. So yeah, a lot of it is trust. And I just want to mention that, like, I play around with DeFi a lot. Like, I'm, interacting with a lot of different things a lot of the time, but it's the way you interact with it is so important. And the fact that we're bringing up the risks and what to look out for is, the way that can help other people navigate without having those same risks involved in their, personal lives.
So when you say interact, what does that essentially mean?
Yeah. So interacting might just simply be going on a different service. So I like to just use the lend and borrowing again. So you might lend your assets to the protocol. There's a smart contract. You click accept. That means that you've interacted with that project. And whatever's on that smart contract will allow it to do whatever it can with the assets that you've lent out. So, if there's smart contract risk and you've interacted with it, then that's where your risk is.
So it could potentially empty your wallet, or a glitch could lock your funds up forever and no one could ever get access to the smart contract, or someone could just hack it all together, right?
Yeah, exactly. So that's just simply what interacting with.
Okay, so a typical interaction would be you'd take your coins from your wallet.
Yep.
You'd put it into another wallet perhaps that's connected to this smart contract, or with the intention of connecting it to the smart contract.
Yep.
You'd say, yes, I want to borrow. Mm-hmm. You'd take the borrowed funds, you'd probably move it elsewhere, and then you'd do your business.
Yeah.
So that would be like a typical DeFi interaction, right?
Yeah, exactly.
Okay, that makes a lot of sense. Thankfully, at Uptrade, in the almost 2 years or 1.75 years we've been in operation, we've actually been able to prevent probably about 30 or 40 different scams. Thankfully, some of our customers, they really respect what we do. They trust that we are the ones in the industry that can take a second look at things. And a lot of them have come to us and said, hey, look, I'm thinking about working with this company, or I'm thinking about depositing funds here because they're offering great returns. And we've actually had a good look, and we've been able to look through the website, realize that it was created in Somalia, and that, the yields are completely fake and it's literally just a fraudulent operation. So I do urge anyone who's watching, if you are planning on doing something like this, it just takes 2 seconds just to send an email to your broker and go, hey, look, I'm thinking about doing this. They're offering me this, or they've reached out to me somehow randomly.
Yep.
Even bigger red flag. And hey, could I just get your eyes over this for a second? Do you think that this is risky or a scam? At least we could sort of give a pretty clear answer on that, I believe.
100%.
So thankfully, we've been able to prevent a lot of scams with our customers. But unfortunately, there always is a few that fall victim, which is pretty sad because, this is what we're here to try to do. We're here to be the shield in the market, not only to provide the real unbiased research and analytics. We're also here to try and provide a safe avenue so people can transact with the industry in and out and swap and whatever it is. But also, there are a lot of bad actors out there too. There are millions of bad actors out there. So please, I implore you, if you ever come across something that's too good to be true, please use your senses. Please use us as a second opinion. We're here to help.
Yeah, definitely.
So let's move on to staking, a really hot topic. This year, a lot of people are asking us about how to stake, where to stake. But, there are a lot of risks with staking as well. So you want to sort of touch on what staking even is, Kane.
Yeah. So staking, if you're going to simply compare it to something, is basically earning interest on your savings. So if you had money in a bank, you could earn interest on your savings. It works in the same way. A couple layers to staking. There's one, being able to secure a network. So it is a bit technical and we don't have to go into too much detail around that. But basically, in its simplest form, is you stake your tokens on a network like Ethereum. And because you're providing security to that network, they will reward you in their tokens. And that basically allows the network to run in a decentralized manner. The other ones are staking with a centralized exchange. So, for example, Binance offer it, KuCoin offer it. A lot of the big exchanges offer staking where you can, stake your token and you can also earn interest on those. So that's probably a really big one that a lot of people would see. And the third one is using it in DeFi, which is similar to what we already discussed, which is maybe like lending and earning APY or providing liquidity to different decentralized exchanges.
Okay, so providing liquidity would mean that I could put my 100,000 USDC into a smart contract, for example, and because I've given liquidity for people to use in the pool to buy and sell or whatever the function might be, I get a reward.
Yeah,
for
exactly.
that, right? Okay.
Yeah. You would earn a certain percent of the fees, and that will be your reward, basically.
Okay, so let's say there's a pool of 100,000 uptrade token,
Yep.
and there's 100,000 USDC, and there's a market of people constantly buying and selling this coin, right? There's people that want to buy it, that people want to sell it, right? So each time someone interacts with this, it would generate a fee,
Yep.
and because I've put up the collateral, essentially, I would earn money from the fees. Is that correct?
Yeah, exactly. And that's what your staked yield would be. So obviously
Okay.
your tokens being as liquidity would mean that you're earning some of that yield.
Okay, so there's a few sort of ways it looks like to cut the sort of cookie here, and they all
Yep.
kind of come with their own set of risks. Some of them the same, and some of them are unique.
Yeah.
Why would someone want to stake their coins?
I think it again comes down to having a passive income and attractive yields. People just want to get the most value out of their assets. And that's more or less at the end of the day what a lot of people do, especially on centralized exchanges. I know we haven't really covered that, but it's another big one because, they can offer sometimes big yields, sometimes not too big, but obviously you're exposed to the centralized risk at that point as well.
So centralized risk, that's another risk again.
Yeah.
So could you just cover what that actually means?
Yeah, definitely. So centralized risk means that there may be an intermediate party that you have to rely on when it comes to holding your assets or using your assets. So for example, in the modern world, our centralized risk might be a bank or our insurance company because they're the ones that are, using our liquidity or funds to facilitate their service. So that's our centralized risk. And that can occur with crypto when it comes to an exchange like Binance. They're a centralized entity, and that's our risk. That's the middleman that acts as a bank.
Okay, so a centralized risk kind of implies that there's a single point of failure. If one place goes down, then you're probably not going to be very happy, right?
Yeah.
Yeah, because we get asked this a lot. People say, oh, should I keep assets here? Should I do that? Should I do this? Obviously we can't advise on that because they all come with their own sets of risk, right? But one thing we do tell people is it's probably not a great idea to keep everything in one place. Staking is essentially for people that want to earn money on their assets. They don't necessarily want to sell them. But obviously, there's a potential that you are staking 100% of your coins for a 15% return, taking on 100% of the risk.
Yeah, exactly. So, look, staking is not all doom and gloom, as we said before. For example, I do stake some of my coins. I just do it in a way that I'm not losing sleep over it. And I know that the people I'm staking my money with, or if I'm doing it on DeFi or validating a network, that's a secure and a pretty low risk way to do it. And, able to jump over any hurdle that might come my way with that as well.
Yeah, we've had a sort of internal discussions, you and I, about this in the past. And, when I asked you about what protocols are good and what's safe and things like that, it looks like you actually go into quite a lot of diligence. Like you actually, potentially look at these things for weeks before you even consider placing even $100 on these platforms. And even then, when you do place funds, or when you have placed funds, it's never a lot. It's never like a huge amount. It's not like if that smart contract collapses, you're not going to be out in one foul swoop.
Yeah.
It's like a portion. Like, how would people, if they wanted to do this, what would be a sensible way to manage your risk around this?
Yeah, so the main way I try to manage risk is by diversifying my staked tokens. Obviously, number one, you're not going to stake 100% of your tokens because that's where you hold all your risk then. So for example, if you wanted to stake 10% of your tokens that you hold, you might put 2% in one place, 2% in another place, 2% in the other place, and that means you've got 5 different places that you're putting your money in, and that, you know, if one of them goes down, then you've only lost 2%. But, you know, if you had 10% in that one place and it went down, like that's where the big risk is. So being able to diversify across 5 of the best, or the 5 of the, you know, most trustworthy services is probably what I would say is a good way to do it.
Okay. So it sounds like that's a lot of work, because if we go back to the example before of the typical DeFi interaction, you would essentially need to go through this route 5 times. And you'd also need to monitor on a daily basis how they're going.
Yeah, exactly. I'm not going to lie. This is for a lot of tech savvy people. Like for myself, honestly, it took me quite a couple years just to, learn to navigate DeFi. It's so hard to understand at first. And to be honest, if you're just doing it for like 5 to 10% and you're not sure where you're putting your money in, to me, honestly, it's not worth it unless there's someone to hold your hand and help you know where, you might be able to trust. But at the same time, you can't trust anyone really. You just have to be, able to understand the risk and, willing to learn and do that work, then sure. But I wouldn't recommend it for most investors who don't understand DeFi and aren't very tech savvy.
Okay, so there's a time investment, there's a learning curve, there's hidden risks that aren't really apparent at first glance. So there's quite a lot there. And I guess for people watching, I think, it comes down to what kind of investor you are. If you're really hands-on and you're doing crypto trading every day and you're happy to take risks, then sure, maybe this is for you. But for people who are kind of taking a back seat, they might buy every now and then, whenever there's a Black Friday sale in crypto, like we've seen the last couple of weeks, but you're predominantly kind of hanging on to leverage out, it might be more stress and more risk than it's worth, would you say?
Yeah, I think 100%. Like my stress levels probably have gone up since, interacting with DeFi myself. And, I know more than anyone about this stuff. So, the fact that I can get stressed around where, my money is in different projects and, you can get lost in it a lot of the time. So if I can get lost, anyone can get lost. And trust me, it's not a really good place to be when you're not sure where different tokens or where you might have interacted with, Yeah,
we've rescued quite a few people over the last year. People saying, oh, well, I deposited my funds here and now I can't get it out. And, oh, geez, look, we're happy to help, of course. But, if you're out of your depth, it's probably better to do more research. But, hey, look, regardless, we're here to help. So reach out.
Yeah, definitely.
As Kane mentioned, look, it's not all doom and gloom. As we know, crypto moves very quickly. Technology is moving at an unprecedented rate. There probably will be a time and place where this stuff will be user-friendly, 100 times safer and easier to interact with than even your own bank. So, yeah, watch this space, watch it closely. There's going to be a lot more innovation. And, we are going to be talking a bit more and I guess higher sort of levels of this will take steps in the future and how it sort of iterates into different products and financial products. We'll probably cover real world assets next because that would be under the DeFi umbrella, I imagine.
Yeah, and as you said, it's like a 5-year, this sector is only 5 years old.
We even have AI, creating smart contracts now, even auditing smart contracts. There's so much happening in the space, and we hope that you enjoyed our explanation of DeFi, and we hope that we can sort of build on this. And if there's any other sort of topics that you'd be interested in that just kind of go straight over your head, please let us know because we want to start at the grassroots level and we want to be able to build on that knowledge and provide that value because part of the digital revolution comes a lot of new innovations, a lot of new movements, and you really do need to be aware of them so that you can understand opportunities when they come your way.
Yeah, and I think me and you, we learned the hard way. We had to go through it all ourselves and navigate the space when we didn't have the information that a lot of people have today. So being able to obviously offer our expertise and our insights so that you can kind of skip a lot of the learning curves that we might have had to go through, is very valuable. And I hope you guys enjoyed the discussion.
So amazing. So one more point before we leave. I hope you obviously enjoyed our discussion about DeFi. If you have any questions, please leave them below. Also, we realized that we've been getting a lot of great reviews on our Trustpilot, and I just want to thank everyone from the bottom of our hearts. It really does provide us validation in what we do every single day. We did make a mistake, however. It turns out we have 0 Google reviews, which does make it harder for people to find us because everybody uses Google. So if you could please be so kind, we would sincerely appreciate it if you could please leave a Google review for us in the link below. I think Kane's going to leave it somewhere.
I will.
So that it can be done. And just thank you so much for supporting us and providing the feedback, the honest feedback that we get. It really does help shape our service and everything we do around your needs. So thank you.